morning, all of you, and a warm welcome. Uh, this is indeed very exciting to be here today. Uh, we've been around 23, 24 years as Alchemy, and I had never envisaged that India would be able to pull off a global financial hub like what GIFT City has done. And let me tell you, it's not easy because everywhere around the world, many countries have tried to establish global financial centers. It takes vision, courage. More importantly, it takes a long-term view, and it requires to get all the stakeholders, and you can't build a global financial center without creating an enabling ecosystem. And then you need a couple of pioneers to take the first step. And I can tell you, when my team told me that, there is this conclave that is happening here and we should take part in it, I said, we should definitely take part in it, because I think we have to be proud about one contribution from our side, a very humble side that we've done to GIFT, is that Alchemy was the first fund to transition from Mauritius to GIFT City. And we took the call, and I still remember various discussions in our office, and there was a lot of debate to say, "Kyun change karna hai? Why do we want to change something that is working so well?" We had an investment manager in Singapore. Our fund was domiciled in Mauritius. We had fairly sophisticated international investors who had invested in our fund, from pension funds, endowments, family offices, globally. And everything was running very smoothly. Everything was set. And people said, why should we be the bali ka bakra, so to speak? Why should we be the first ones to experiment? What if something goes wrong? What if, investors are not comfortable? And I said, no. I said, first of all, when we started attracting global investors into the India story, and mind you, that was 17 years ago, in 2008 is when we launched our first offshore fund. I used to find it very amusing that the best fund management talent for India resides within India, but the biggest funds were raised by people who were sitting out of New York and London and Hong Kong and Singapore. And just because those guys were maybe Indian, they were able to raise millions and billions of dollars of capital. And Indian fund managers who were homegrown, who had experience, who had feet on the street, had to struggle because not everybody had the expertise to set up these very complex structures outside of India, right? I mean, we literally had, you have heard about the term brain drain. We literally had our version of brain drain. That, I was very amused that to manage foreign money in India, I have to first go outside of India, set up a structure outside India, then get money and then manage it, right? And I think finally there was a lot of wisdom and courage and vision of our Prime Minister, who thought about the GIFT City. And as I said, there was a lot of skepticism, because the first thing that a foreign investor dreads is that Indian regulation, Indian taxes, I don't want to be anywhere close to it, right? So you give me anything outside of India in a nice jurisdiction, and I'm very comfortable putting money with you, but not in India. And we decided that we will break that jinx. And I told my team that we should move from Singapore and Mauritius to India, And that's how Alchemy became the first fund to ever get re-domiciled to the GIFT City. So, why come to GIFT City? Well, as I said, I've always believed that an India-dedicated inbound strategy is best managed from within India because the talent resides here, all the research is done here. In fact, today, if you talk to some of the most sophisticated institutional investors outside of India, they are now realizing that they want to work with portfolio managers or investment managers who have feet on street in India rather than somebody sitting in London and managing Indian stocks, because we understand India better than anybody else, right? So very clearly, our long-term vision was to bring both the fund and its management onshore. And with the development of the GIFT City IFC, we have found an ideal platform to realize this dream. I think amongst many other advantages that GIFT offers, I think what we liked was that it is a structure that's globally competitive and India aligned. I think accessing the domestic market has become very easy. I mean, on several trips to outside of India, whether for social reasons or for business reasons, whenever I used to go and talk about the India story, obviously investors' eyes would lit up. Also, many NRIs who had moved out of India and had settled abroad, I mean, kind of broadly read about India or once in a while travel to India, but they were very interested that, yes, I genuinely believe now India is changing, India is growing, we are hearing so much about India. I think our Prime Minister was the best brand ambassador of India globally, and I think the level of interest amongst international investors and NRIs to invest in India has gone up. But one refrain that we would always hear from them was, yaar, bahut complicated. It's too complicated to come to India. How can I as an individual investor come into India? And there were a lot of questions, and therefore, while the willingness was there to invest in India, the ability was clearly not there. And today I can say we've finally reached that level where we can make access to investing very simple. Just like today in India, mutual funds investing has become so simple. At the touch of a button, you can invest money. I think we are moving towards that. Secondly, the second big fear that most people found was our dependence of the offshore structures on a bilateral tax treaty. So for example, India and Mauritius have had a tax treaty. India and Singapore have had a tax treaty. But as some of you would know, that every few years there would be some noise about withdrawing the tax treaty, or there is some uncertainty which crops up as far as the tax treaty is concerned. And there were very complex issues like GAR and taxation. All of those in one shot have gone away, right? I don't have to rely on any second or third country for having a tax treaty and then somebody interpreting that tax treaty and that having uncertainty. I think one very important thing is stability of taxation and a regulatory environment is a very, very important reason and a precondition to money coming into India. And I think that is something that we have achieved. Today, I don't have to go and explain a pension fund guy, compliance guy in North America, telling him, why he should not worry about the India-Mauritius or the India-Singapore treaty, right? The third is obviously the ease of doing business. There is now a well-established ecosystem of asset managers, bankers, custodians, and service providers, administrators, law firms. And lastly, the opportunity to operate in a very tax efficient and cost efficient environment. Talk about no GST on fees. I know people are so happy GST rates are going to come down, lower taxes on dividends and tax exemptions whenever a fund trades on the gift exchanges. Now, obviously right now the exchanges don't have too much volume, but going forward, if the gift exchanges have volume and we start trading on that, we don't pay any taxes, right? So there are a lot of tax efficient features which are there. And then lastly, if we have to talk about, any destination is a great destination if the regulator is great. And I think here 𝐸𝐶𝐶 has done a phenomenal job. And if I were to define this regulator in 3 words, it would be proactive, consultative, and very adaptable, right? And I think, as somebody said here, I think they were all from the government, they themselves realized their limitation. They said, the moment you think of a regulator, your hair pulls away. It's very, you have a concept of somebody being very bureaucratic. He'll go back and tell you, you read and come back, don't ask me for the interpretation. I think this is exactly 180 degrees opposite to that. I think the regulator here is very, very proactive. They are very investment friendly. They are willing to have the spirit of partnership to basically allow players to come in and set up operations. So while we re-domiciled our long-only fund, which we were running for 17 years to GIFT City, we also have future plans. And over the next few quarters and years, you will see Alchemy launching a long-short fund here in GIFT City. One of the advantages is that when you do long-short, if you trade in derivatives, any gains that you make are completely tax-free, right? And therefore, India can really be very competitive when it comes to certain strategies like long-short. And a lot of global investors are interested in strategies like the long-short strategy. And, we are certainly have something in the works. Secondly, we are also looking at a hybrid strategy, which is a crossover between giving global investors access to not only the listed companies in India, but also giving them an opportunity to invest in private equity. Many young entrepreneurs in India today are breaking out. You have great ideas. A lot of foreign investors want to participate in some of these new entrepreneurs and, new ideas that are coming up, invest in pre-IPO. So a hybrid strategy. And lastly, outbound. Equally interesting is Indian HNI and ultra high net worth individuals and families wanting to diversify their portfolios and invest outside of India, whether into US equities or global equities. And these are the 3 opportunities other than the inbound long only that we are looking at. I already spoke about 𝐸𝐶𝐶, so won't spend too much time, but they've been a great partner. I'm just going to spend a few minutes. I know talking about India, we could spend hours together, but I'll just touch upon a few things why India is no longer just another emerging market, right? Obviously, we all hear about the fact that India is the fastest growing global economy. We will be the 3rd largest economy very soon. But I'm going to handle 1 or 2 questions which are usually top of mind for global investors who want to come in, right? First is currency, right? And they always say, what is the outlook on the rupee versus the dollar? Because obviously all these guys earn in foreign currency, but when you invest in India, historically over a very long period of time, at least since we've run a fund for the last 17 years, on an average about the global investors lost 4% a year on currency weakening. And therefore, that is always one concern that foreign investors have. However, we do believe that some of the recent events that we have seen, the kind of trade policies that the Trump administration is trying to implement, uh, and we've already seen the dollar fall by 10% from early this year. And again, anything can happen in global macro, but our research and our firm belief is that the dollar has probably peaked out, right, over a long period of time. I think that whatever be the objectives of the current US administration, but I think the series of steps that they have taken has definitely punctured the trust that was gathered in US assets. And therefore, while I don't think that in the short to medium term there is an alternative to the dollar, but I certainly believe that the dollar strength that we have seen has peaked out. And I tell a lot of my global investors that possibly going forward, while the best case may be that the Indian rupee doesn't depreciate against the dollar because the dollar becomes weak and the rupee becomes stronger, but I certainly believe that the depreciation of the Indian rupee versus the dollar will not be to the extent of 4.5%, but probably could be half of that, maybe 2%, right? So that extra 2% can come as your return in your kitty in case the rupee doesn't depreciate beyond a point. The second thing, and I know there are a lot of figures here, and people talk about should I invest in the US versus investing in India, and what kind of returns can I get? And I can tell you that we looked at most emerging markets, and while in the current year India has underperformed dramatically for various reasons that we know about, but if you look at the very long run, probably with the exception of Taiwan, the Indian markets have done better than any other emerging market. And over the very long run, above 15 years, India, and these are all, I've used the MSCI India index as a representative of the Indian market. India actually stands out as one of the very few emerging markets which has the ability to compete with the S&P 500 and deliver fairly strong returns. And these numbers, at least in the near term, have been impacted by, 1 year we are lower, as I said, this year because of the trade and tariff impact on India. India has underperformed global markets and emerging markets dramatically. But over the long run, India has delivered fairly consistent and superior returns compared to many other large emerging markets, whether it is China, Korea, Thailand, and so on and so forth. Obviously, there is a lot of worry, and I've had a lot of calls from some of my NRI friends who live in the US, कि क्या हो रहा है, what is happening between India and the US, and there is an obvious worry, and I tell them that, look, don't read too much newspapers, and India's economy is far more resilient than what people may have you believe. India is still a largely domestic-driven economy. At 4 trillion, our exports are just 11.5% of the GDP. And amongst that, our trade with USA, goods trade with USA is only 91 billion, which is just 2%. And if I estimate that this additional 25% on top of the 25% reciprocal tariff, even if that was to stay back, the max impact that it would have on the GDP is 0.5% of GDP, right? And obviously, nobody expected what happened, but as you know, the government has moved very proactively to cut GST rates, and I will show that how the adverse impact of trade will be taken care of going forward in the future, right? So I think what has happened is that this government in the current year, last year, as you know, we had quite a bit of a slowdown because of the elections. Government couldn't spend money. And also we were running a very tight fiscal and monetary policy. But that has changed in the current calendar year, right? So we've had the government now come and aggressively stimulate growth. So in the budget, we cut income taxes to the extent of 1 trillion. And if I were to take a conservative estimate of how much tax benefit the GST cut would bring, that would be somewhere in the region of another 1.5 to 2 trillion, right? So if you take the total benefit at 1 trillion for the income tax cut and 1.8 trillion for GST, the total benefit is almost about 2.8 trillion, which is 0.85% of GDP. So what I was trying to say is that even if we take a hit on tariffs, which is on our growth, which is 0.5% of GDP, that is more than compensated by the combination of income tax and GST tax cuts, which will actually benefit to the extent of 0.85% of GDP. And therefore, we believe that the India's markets are very, very resilient. And I think Mr. Rajaraman mentioned that, one of the reasons also why the Indian rupee used to constantly depreciate against the US dollar was because we had very high inflation compared to the US. And one of the things that has changed in India is that structurally inflation has come down dramatically. In fact, today US inflation is higher than India's inflation. And that is the reason why there is more confidence today. The Indian rupee will not weaken as much as it was weakening historically. And today, apart from the fiscal, I think you have the twin engines in an economy. One is fiscal policy, another is monetary policy. We are seeing both fiscal and monetary policy has been turned on. The engines of growth have been turned on. So monetary policy, we have seen some rate cuts. We have seen amping down of regulation. And this is something that we are seeing across. Whether you look at SEBI, you look at RBI, we are now seeing that regulations are starting to become more business friendly, more market friendly, more economy friendly, right? And I think a combination of tax cuts, liquidity being poured by RBI and rate cuts would mean that in the second half of the year, we should see an acceleration. I'm still confident that in the next 30 to 60 days, we should see some resolution as far as the trade and tariff war is concerned. And I wouldn't be surprised, and we've been really telling our global investors that, this is the time actually to amp down and put money in India. I think India's macro has never been as strong as it has been. It is just this current uncertainty around trade and tariffs that is holding back our markets. But had it not been for them, that I think by now our markets would have been off to the races, right? And I think one of the other important thing is that we are now seeing a very wide variety of opportunities to invest in India. And, whether it is data center and AI, whether it is defense, whether it is green mobility, the whole digital stack, the fact that we are seeing new breakout entrepreneurs in India. We get, Indian investors used to get always very excited about the fact that they could invest in a Google or a Tesla because they don't find these kind of companies in India. But I think that we are finding, very, very vibrant entrepreneurs who are coming, who have used India's digital stack. For example, Zomato or Eternal, as it is called, the best food delivery company and the best quick commerce company in India does not come from any of the well-established business groups of India. They're not from the Tatas or Ambanis or Birlas, but it's a first-generation entrepreneur who has built a great business and is today giving a run for its money to a lot of the established business houses. So there is now a demonstration effect, right? If India can say that you have first generation entrepreneurs who can build great businesses at scale using India's digital capabilities and access to capital, I think that's a very compelling story for foreign investors to start investing in India, because we will create our own internet champions, we will create our own digital champions, and I think there is a lot of opportunity there. Just very briefly, as I said, Alchemy India Long-Term Fund, this fund was set up in 2008, as just in the middle of the global financial crisis with a lot of turbulence. And it is one of the very few funds, while GIFT City is a new baby, but I think what we are able to give global investors is a fund with a 17-year track record. I think not too many funds can boast about the fact that when they try to look at accessing India through the GIFT City, at least they will now have the advantage of investing in a fund which has a long track record. And as you can see, we've delivered since inception 11% net dollar returns compounded versus the BSE 500 in dollar index, which has given about 6.6% over the same period. And we've been able to deliver a very handsome 400 plus basis points of alpha compounded over 17 years, right? So finally, I'll probably stop here and say that, GIFT City is a very definitive step towards globalizing India's capital markets. And this is just the beginning. Small countries like Singapore and Hong Kong have become very large financial centers and manage trillions of dollars. I think I see a day and time 10 years from today, 5 years from today, that the amount of investments that will come into India funneled through GIFT City will move into billions of dollars and eventually into trillions of dollars. So with that, thank you all for your patient listening.